Hi, CJ here and welcome to Bank Smart Academy, your guide to smarter banking. Today, I'm going to elaborate more on the new tax reform of 2025, which is to take effect from the 1st of January 2026. So sit back, relax, take out your notes and calculators and start calculating your new tax remittance come next year. This isn't a joke. Our president, Tinubu, is indeed really making efforts to widen the tax nets. Now let's dive in. The Nigerian government has passed a major tax reform law, the Nigerian Tax Act 2025, along with related laws to overhaul how taxes are collected. These new laws are the biggest tax changes we have seen in decades. These changes aim to raise government revenue by bringing more people and businesses into the tax nets. But what do all these legal terms mean for the average Nigerian? In this video, I will break down how personal income tax works under the new law, what small businesses will pay, how the law affects the informal sector like market traders, drivers, and online hustlers, and how the government plans to enforce these taxes. I will also show you why yourself and many other Nigerians out there should be worried. My goal here is to explain the key points in simple terms with examples and references to the law. Shall we begin? So let's begin with the personal income tax. Who has to pay? Well, under the new law, if you earn below 800,000 naira, which is approximately 66,667 naira, you won't have to pay any income tax. According to this new tax law, the tax collectors have included this tax-exempt threshold to shield low-income earners, for example, workers making around minimum wage, from taxes. However, once your income goes above 800,000 naira a year, you will owe personal income tax, and the more you earn, the higher your tax rate will be. Shocking. The Nigerian Tax Act 2025 introduced something called a progressive tax rate structure for individuals with rates ranging from 0% up to 25% for the highest earners. In plain terms, progressive here means rich people pay a higher percentage of their income in tax than poorer people do. While this is true in theory, the tax will still pinch the poor guy more. We'll get into that shortly. The question I have next is, how will this tax be collected? Well, these tax collectors have indicated that it's not going to be a flat percentage on everything you earn. Instead, your income is divided into brackets, and each bracket is taxed at a different rate. This is after subtracting any relief or deductions you are allowed. So in simple terms, what are deductions? Deductions are expenses or amounts that the law allows you to subtract from your gross income before calculating tax. Alright, so example, I will say if you earn 5 million in a year and you're allowed a deduction of 500,000, say pension contribution or business expenses, then your taxable income reduces to 4.5 million naira. Right? So we say that deductions reduce the income on which you are taxed. Now, what about relief? Relief are the allowances or exemptions the law gives you, sometimes regardless of actual expense, to ease your tax burdens. I'll give you an example. An example is, say you are entitled to a consolidated relief allowance of, say, 1 million naira plus 20% of your income. Now, this further reduces your taxable income before tax is calculated. Another is personal allowance as example of relief. Okay, according to the law, 0 to 800,000 will be taxed at 0%, completely tax-free. For the next 2,200,000 naira, that is from 800,001 naira up to 3 million naira, will be taxed at 15%. That's for the second bracket. The first bracket is 0 to 800,000, completely tax-free. Second bracket is from 801,000 to 3 million naira. The second bracket is taxed at 15%. Right? So now the third bracket is the next 9 million naira. That is to say, from 3 million to 12 million will be taxed at 18%. The fourth bracket is the next 13 million. That is, from 12 million to 25 million naira will be taxed at 21%. The next 25 million naira up until 50 million will be taxed at 23%. This is the fifth category. And any remaining cumulative above 50 million naira, you are getting to the 25% threshold. This is the top rate for super high income earners. What this means in effect is that the first 800,000 of your yearly income is completely free from taxes. Any income above that is sliced into chunks that gets taxed at those increasing rates. So how will this work in real life? Now imagine this. Someone earns 1.2 million naira in a year, that is approximately 100,000 per month. The first 800,000 is tax-free, while the remaining 400, however, falls into the next category, which is from 801,000 to 3 million, which is taxed at 15%. Now this individual pays a tax of 60,000 naira in a year, which is 15% of 400,000. This looks small, right? Well, government says that 60,000 naira is only 5% of the total 1.2 million naira income. So this is a low overall tax rate. However, what this said government has failed to factor in is that this individual will not be getting deductions for the high cost of transportation, for the cost of feeding, for medical costs, and to mention just a few. In reality, 100,000 naira doesn't solve anybody's monthly expenses in our current day in Nigeria, because when you divide that into 30 days, all you get is approximately 3,330 naira per day. Yet the government is saying you owe them 5,000 naira every month if you earn up to 100,000 per month. Now let's move to the next income brackets. If you earn 6 million naira per year, which approximates to 500,000 per month, you fall into the second bracket. Let's calculate how much you pay. Approximately, you'll be required to pay roughly 870,000 naira in taxes for the first year, which is about 14.5% of your overall income. I'm sure you know that for a job paying you 500,000 per month in our current day Nigeria will most likely be in a location that demands high rent. Well, if you don't own a home, Tinubu has promised you a relief of 500,000 naira for housing. Sounds good, right? Now let's look at it. If you earn 6 million a year and you're allowed 500,000 for housing deductions, you're left with 5.5 million. You still fall into the second category that will be taxed from 801,000 naira to 2.2 million. You'll be taxed 15%, and the balance on that is taxed. Well, the 500,000 naira allowance or deductions from your total yearly income, I hope it covers a lot for you. I've not even mentioned the house maintenance, I've not mentioned your children's school fees and all of that. Well, the government doesn't care about all of this, they just want your taxes. Now, for someone earning 60 million naira a year, it approximates to 5 million naira per month. If you find yourself in this income bracket, you would owe about 12.93 million in taxes. That is around 21.5% of your overall income. These examples show how the percentage of income paid in taxes rises as income goes up. Also, I need to add that in addition to wages or salary, what counts as income under this law is now broader. The tax law explicitly states many types of earnings are now taxable, not just your paycheck, but also things like profits from a small business you run, income from investments, capital gains from selling assets, prizes and awards, freelance or gigs earnings, rent you collect, and many more. Even crypto and NFT gains or other digital asset profits are now considered taxable income in Nigeria. Previously, such things were not clearly taxed. They were even criminalized at some point. Also, if you receive valuable benefits from your employer, let's say you live in a company-provided apartment or drive a company car, the law has rules to value those perks and tax a portion of them. Like I pointed out earlier, the law removed the old consolidated relief allowance and introduced a new rent relief. Now, the relief is this. If you pay rent on your home, you can deduct 20% of your annual rent up to a maximum of 500,000 naira from your income before tax is calculated. If you own your own home, well, I'm sorry, you don't qualify for that allowance. So our next question is this: how will you actually pay this tax? Well, the standard practice which continues under the new law is to pay as you earn. If you work for an employer like a company or the government, your employer will withhold the tax from your salary each month and pay it to the tax authorities on your behalf. It's much like how deductions for your pension or health insurance are taken from your pay. In this case, it's called income tax. In this, how then does your employer value your supposed deductions? For example, if you pay rent, you are allowed 20% or 500,000, whichever is higher. Now, with these deductions in consideration, your employer just removes your tax and pays you net, maybe after the corporate deductions of pension and health insurance. How does your employer know how much you pay for rent? How does your employer calculate 20% of your rent? Or they just have an assumed sum of 500,000 per annum deducted from your salary or your income? Moving on. At the end of the year, you are supposed to file a tax return, a form showing your total income and taxes paid. But for many formal sector workers, the actual tax paying is already handled via this pay as you earn. If you are self-employed or running a small business as an individual, things are a bit different. You are expected to register with the tax authorities and file an annual income return declaring your earnings. This new law still requires this, but it promises to simplify the process for people with very low or irregular income. There's a concept called presumptive taxation, introduced for the formal sector. We will explain that in a moment when we talk about informal workers. But what does this presumptive tax mean? In simple terms, it means that if you don't have proper accounting records, the government can assume or presume your income at a certain level and tax you based on that, rather than have you file all the complicated forms. Think of being kind, right? Well, the exact method and rates for this presumptive tax is to be determined by the tax authority in your area. Does this mean that different states or areas are flexible with the rates and it's not fixed? Well, the Minister of Finance was given the mandate to set that much later, but before it's done, rates can be set by authorities as they like. Now look at that. According to Tinubu's tax collectors, this is meant to make life easier for spot traders, artisans, and others who don't have an accountant. Before moving on, I should let you know that the new tax rates and rules officially takes effect from 1st of January 2026. So all income you earn in 2025 is still taxed under the old rules, and new system starts applying to income from 2026 onwards. Now let's talk about businesses, because because I've seen some advice around registering your business and keeping better financial records. How will this help the small businesses in the new tax regime? The Nigerian Tax Act of 2025 doesn't only cover individuals, it also overhauled company taxes. If you own a registered business, that is, a company or plan to start one, here's the good news. Small companies are now effectively tax exempt on their profits. A small company in this regard is defined in the law as one with annual turnover of 100 million naira or less, and with total assets not more than 250 million naira. For context, 100 million naira in annual turnover means your business brings in a total of 8.3 million naira monthly. That is over $120,000 every year, depending on the exchange rates. So this category covers a lot of businesses, that is, small and medium businesses in Nigeria. If your company's turnover is 100 million naira or below, you will pay 0% company income tax on its profits. While the aim is to encourage small business growth and not burdening them with corporate tax, what the government is not telling you in clear terms is that not every business gets this free pass. Yes, there are certain types of businesses that are excluded from the small company category, even if their revenue is low. For example, professional service firms like accounting firms, law consulting firms, and maybe some others are not allowed to claim small company status. The reason is, the government claims that such firms, even if small, often have high profit margins, and the government expects them to pay taxes regardless of size. So if a firm is excluded, it pays the regular tax even on low turnover. Aside from those exceptions, most startups and local traders that incorporated and makes over 100 million naira sales won't owe company taxes at all. But what about the bigger companies? Now, the law keeps the standard company income tax rate at 30% of profits for companies above the small threshold. So medium and large companies with turnover over 100 million naira will pay 30% of their taxable profits as income tax, same as before. There is a provision that the president may reduce the 30% rate to 25% for certain favored sectors, perhaps manufacturing or agriculture. This will be done by an executive order, but as of right now, it's still 30%. So for example, a large manufacturing company making 1 billion naira in profits would owe 300 million naira in corporate tax, that is 30%. Note, however, that corporate tax is on net profits, not on total revenue. Besides income tax, companies in Nigeria also deal with other taxes like value-added tax, VAT, on their sales, which is currently 7.5% on most goods and services, and they must act as tax agents, that is, they have to withhold taxes from payments and remit VAT they collect. Well, the new tax law updated some of those too. For example, it modernized VAT rules and requires electronic invoicing, what we call e-invoicing, and electronic tax systems to improve compliance. So if you run a small shop or startup, it might be worth formally registering your business to enjoy the tax exemptions for small incorporated companies rather than operating informally. But of course, being a registered company comes with other compliance requirements too. Now, how about the informal sector? You see, the estimated majority of workforce in Nigeria works in the informal market. Think of street vendors, market women, buses and keke drivers, the artisans like carpenters and plumbers, freelancers and POS operators. Traditionally, many of these people did not pay income tax to the federal or state government. This is not to say that they don't pay other taxes like VAT, electronic transfer levy, market store fee, union dues, local government levies, and other informal taxes that they are usually made to pay in the markets to various tax forces. Now, added to all of that, the new tax law explicitly aims to bring more of these people from the informal sector into the tax nets. This is the most controversial part of this new law. It has to do with this phrase, presumptive tax for informal earners. So what does this mean, this presumptive tax? According to this new law, a mechanism called presumptive taxation targeting informal sector earners who have no reliable income record has been introduced. What this means is, if you are a self-employed person or micro business owner who doesn't keep formal accounts, the government can assess your income in a simplified way. For example, based on your type of trade, the estimated sales, or even feasible indicators like the size of your shop, the exact presumptive tax rate and method will be set by the finance minister, and guidelines are expected to be issued. The idea is to have a simple flat tax or percentage of estimated turnover that such individuals can pay. For instance, the tax authority could say market traders with turnover of around 2 million naira a year should pay a fixed percentage or amount as tax. Also, commercial drivers pay a fixed amount per quarter, something of that nature, and can be collected through the unions or means they see best. However, even under presumptive schemes, the law's basic threshold still applies. So, if an individual income is below 800,000 naira, they are exempted. With this setup, the government expects a lot of petty traders and artisans who make, say, 50,000 naira a month, which is less than 600,000 a year, not to have them pay income tax at all under this new law. They are theoretically below the taxable threshold. The challenge is that many informal workers don't even know this threshold exists or how to report income, and they might just get caught up in the nets if someone decides to pay more of an item just to support their small businesses. Ordinarily, this should be a gift to them, right? Because as you will soon see, the burden of proof is on you, the taxpayer. Take for example, a keke napep rider or motorcyclist, an Okada rider might gross 5,000 naira a day. If working most days, that could be over 1 million naira a year in revenue. Of course, they have high fuel and maintenance costs, but without proper records, how will tax authorities know their profits? Although these expenses are supposed to be deductible before tax, but as we all know, the informal sector don't keep records. So how will they tell how much was spent on fuel and maintenance and local taxes on the road? This is where presumptive rules might say, we assume your profit is X% of your takings. The law says it is to take profits and not the seed capital. But for informal businesses with no paperwork, they may use rough estimates so that only a portion of your turnover is considered profits to be taxed. But working with estimates like this results in a lot of errors, thereby leaving so many people in more hardship. One common question around taxing the informal sector has been, will market women, hawkers, and POS agents actually start paying taxes? Well, if you let Tinubu have his way, yes. If they earn above the threshold of 800,000 naira, of course, they will start paying taxes. And this is where the next controversy lies. The government has signaled that banks and other data sources will be used to identify those with significant income, even if they are informal. One key mechanism is requiring banks to share information on accounts. Under the new rules, banks must report to the tax authority any individual bank account that has over 25 million naira in total transactions in a year. Note: the term here, total transactions, not clear if it's total debit and credit. There is no way to separate profits from capital when you broadly say total transactions. 25 million a year is just 2.1 million naira per month on average, or roughly $16,000 a year. This means if a trader or freelancer's account is very active, that is money in or out above that threshold, the tax authorities will be alerted. There are even reports that banks will have to flag accounts with over 5 billion naira of transactions in a single month as well. So let's say a contractor receives 6 billion naira part payments. Of course, we know that 6 million can't start and complete a house in modern day Nigeria, so this money was given to build a house. The tax authorities will knock on his door just because he got a total transaction that crosses the threshold. Do you see how concerning that is? Rather than waiting for everyone to voluntarily file taxes, the government is using financial data to fish out potential taxpayers, using total bank transactions to assume someone is within a particular tax bracket. Another enforcement tool is the requirement of a tax identification number for banking. Starting January 1st, 2026, every person and business will need a tax ID to operate a bank account in Nigeria. In other words, no TIN, no bank accounts. Banks will ask you for your tax ID when you try to open an account, or even to continue using an existing account. This doesn't automatically mean they charge your account, but it forces everyone into the tax system formally. If you don't have a TIN, you might be blocked from making transactions. For an informal worker who never registered with the tax authorities, this rule will push them to register and get a tax ID even if their income is low. So what happens once an informal business transaction exceeding this threshold is identified? Well, let's say a self-employed tailor gets a total transaction of 5 million naira in a year from sewing clothes. She exceeds 800,000 naira, right? So technically she owes some taxes. If she has good records, invoices of expenses on fabrics, etc., she could calculate her profits. Maybe only a small profit is taxable, but if not, the tax authority might apply a simple assessment. For example, assume that 50% of her revenue is profit, that is, 750,000 naira is taxable, and applies individual tax rates on that. Now, let's talk about digital creators, influencers, and freelancers. What does the tax law say? If you make money online, whether as a YouTuber, Instagram influencer, TikTok content creator, freelance programmer, graphics designer, online writer, or even a crypto trader, the new tax law has you in mind. For example, if you're an influencer who gets paid by brands for adverts, or you earn from YouTube monetization program, or receives donation, all that counts as income that should be reported. If it is above 800,000 a year, you owe some taxes on it, just like any other self-employed person. Since many digital creators operate as individuals and not registered companies, their income tax falls under the personal income tax system we have described earlier. Freelancers and remote workers, like Nigerians doing programming or design gigs for foreign clients, will also fall under this. Previously, some might not have paid any tax if they were paid from abroad into domiciliary accounts or online wallets. Now, with the push for tax IDs and banks reporting, it will be harder to stay invisible. So if you fall under this category, the key for you is to track your income and expenses. If, for example, you're a freelance graphics designer earning 2 million naira per year from various clients, you should also note your business-related expenses such as software subscriptions, internet bills, and the rest. Those can be deducted, so you are taxed only on your net income, which is profits. If you don't keep any record, the authorities might tax the gross, which is 2 million naira, assuming most of it is income. Now, let's talk about enforcement of this new law. How will the government go about taking their taxes? While the government cannot legally just reach into your bank accounts and take taxes at will, what they can do is, if you owe tax and you refuse to pay, they can obtain a court order or use powers given by law to recover the debt from your bank. This, for instance, by freezing the amount you owe. But this would happen after assessments, notifications, and likely court processes. There is no provision in the law that says a percentage of every deposit will be immediately debited as tax. That said, the government is going to be closely monitoring bank data to catch those who aren't paying or under-reporting taxes. As discussed earlier, banks will report accounts with large transactions, for example, over 25 million naira a year. Furthermore, by making tax identification numbers mandatory for bank accounts, the government links your financial transactions to your tax profile. If you regularly deposit, say, 1 million naira every month, but your tax filings thereof don't match that, the tax authority can investigate and ask you to explain where the money comes from and why you haven't paid tax on it. So how will they know what is profit versus what is capital? Well, the new tax law recognizes that. It speaks of taxing income, profits, or gains, meaning the gain you realize after subtracting costs. So in principle, the government doesn't want to tax your seed, only your fruits. But the burden is on the taxpayer to show what is profits and what is just pass-through money or capital. This means keeping some form of records or evidence of your expenses and costs. For formal businesses, this is quite straightforward. They keep accounts, and profits equals sales minus expenses. But for individuals, especially informal ones, it is quite tricky. If the tax authority sees a lot of money in your account, they might initially treat it as income unless you prove otherwise. For example, if 5 million naira enters your account and you claim that wasn't income, that was a loan from a friend, or that my savings I moved from another account, you would need to provide proof like a loan agreement or evidence it was an already taxed source. Also, to add, if you loaned money to someone and the person pays the capital with interest, that interest is charged. If you sell your car and bank 3 million naira, that is not income from work or personal assets. Like, one's car may not attract taxes, but to the taxman, it is just another 3 million naira deposit. So you see why clarification is needed here. This is where proper record keeping and documentation becomes important for anyone with significant transactions. The law does not have provisions about not taxing certain capital receipts or one-time events, and there is a process of explaining those during tax audits or inquiries. Now, for regular businesses and high earners, though the expectation is to report actual profits and income, your tax will be on profits. All inflows to an account are not automatically taxable income, only those that represent income. If you transfer 1 million naira from your personal savings to your business account, that's not new income, just moving money around. If you get 1 million naira from selling goods, that is income, it's expenses to net off. If 1 million naira is a loan you received, that is not income. Loans aren't profits, though note that if you never pay back a loan and it is forgiven, then it could become an income in the books. So how will freelancers and informal folks prove what is taxable? Well, they will likely need a separate personal and business forms to some extent and keep basic records. One tip here is to have a dedicated account for your business earnings and use it to pay business-related costs. That way, when the statements are viewed, it's easier to see money in and out for business. Another approach is to use invoices and receipts, even simple ones, to deduct sales and expenses. The tax authority isn't expecting a roadside hawker to produce audited financial statements. But if a freelancer can show, for example, I earned 5 million naira, but here are 3 million naira worth of expense receipts, this, rent, equipment, data, travel, etc. So my profit is 2 million naira. That will go a long way. If no records are kept, then you are at the mercy of whatever the tax authority assumes. Now, on to my concerns for this new law. You would have seen that the country is going through tough economic times. Inflation was officially over 34% at the end of 2024. The cost of petrol and transportation has spiked due to subsidy removal. Electricity tariffs went up and over half of the population now lives in poverty. So why place more burden on them? The 800,000 naira per year exemption, which sounds high on paper, actually isn't that high in today's economy. 800,000 naira per year is 66,667 naira per month. But an average family in a city might need much more to meet basic needs. Now imagine this: a mid-level civil servant with 2 children in urban Nigeria, he will need at least 150,000 naira monthly for basic needs. So taxing incomes above 66,000 naira means taxing survivors itself. In other words, people earning what cannot even be considered a living wage will now lose some of their income to taxes, potentially pushing them into more hardship. While the richest will pay the highest rates, a significant portion of the struggling working class, that is, teachers, junior bankers, small business owners, especially in the cities, will also be pulled into the tax net due to high inflation, pushing their nominal income above the 800,000 naira mark. For these new taxpayers, they have lost that extra 5k, 10k, or 20k or more per month. That's money not available for feeding, school fees, and even transportation. When many individuals are forced to cut consumption in order to pay taxes, overall consumer spending drops, which can slow down the economy even further. Nigeria already had weak growth and high unemployment. This aggressive taxation now is like squeezing water from a stone. It can dampen economic activity and consumer confidence. There's also the issue of multiple tax burden. Nigerians are now being taxed from all angles. Aside from income tax, there's VAT on goods, that is 7.5%, which possibly might be higher in the future. There are bank fees, there are stamp duties on transactions, there are local government levies, and recently a proposed 5% excise on petrol. That is a fee charged in the new law, though the government said they have postponed that due to public outcry. So to the average person, when you earn, they tax you. When you spend, they also tax you. When you save in the bank, there are charges. When you buy fuel or use your phone, you pay taxes and fees. This tax reform adds to that list of outgoings, which will negatively affect families, especially because salaries haven't risen much in many sectors. There's also a real worry about how the poorest in the informal sector will cope, while technically those under 800,000 naira are exempt. Enforcement might not be so precise. On that ground, the market woman who doesn't understand the details might be scared into paying something even if she earns below the threshold. Sometimes, due to misinformation or overzealous tax collectors. Also, many in the informal sector already pay informal taxes or extortion. For example, bus drivers give daily tax to the union or police. Traders pay market fees and other fees. Adding a formal tax on top of that, even if small, is nothing short of piling on the misery for people who don't enjoy any social security or benefits in return. There is a risk that if collection isn't done carefully, it could lead to harassment of small traders or drivers by tax officials, which has happened in the past with local taxes. There are trust and transparency issues. Nigeria historically has a low tax morale, meaning people don't feel motivated to pay because there are no benefits to paying taxes in Nigeria, if we're being honest. A recent survey found only 18% of Nigerians believe tax money is utilized effectively by the government. Many politicians live lavishly on taxpayers' money. So if the already collected taxes are not being used to improve roads, schools, or hospitals, is it the new taxes that will be used for those? The 2025 tax law is a landmark change. It simplifies a lot on paper, consolidating numerous laws, and tries to make the system more equitable by making the rich and big companies pay more while lightening the load for very small guy and small businesses. However, for the average Nigerian who is somewhere in the middle, not extremely poor, not extremely rich either, it introduces new obligations that can feel burdensome in an already tough economy. Whether this reform hurts or helps Nigerians will depend on how it is executed. If the government can implement it gradually, communicate clearly, avoid heavy-handedness, and above all, show results like improved services or support for the vulnerable, then public acceptance might grow. If not, the skepticism we see today might grow into a resistance. That is, if Nigerians finally develop the balls to demand accountability from their leaders.